photography crew can come to order as well. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled the Federal Reserve Semi-Annual Monetary Policy Report. Not the most inventive title, but traditional. We call Humphrey Hawkins. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note at the outset that this hearing has a hard stop at 1 p.m., which we will strictly observe. The chair would further announce to committee members that the chair's intention is in the second week we return in July, we'll have a markup, and that markup will include 2 important bills. One is giving digital assets a market structure and federal regulatory remit, and the second is a federal stablecoin regime. It is the intention of the chair to have that as 2 pieces of our committee markup in the second week we return in July. I now recognize myself for 4 minutes to give an opening statement. Thank you, Chairman Powell, for joining us today. Inflation remains broad-based and persistent, 2 troubling trends the Fed expects will continue. As you said last week, the process of getting inflation back to 2% is a long way to go. So even though the Federal Open Market Committee did not recommend a rate increase at last week's meeting, it's fair to say that the Fed will continue to make additional increases in the months ahead. We'd like to hear your thinking on those matters. As the FOMC again pointed out last week, the labor market still appears tight, with Fed policymakers projecting a rise in an unemployment rate to a still low 4.1% at the end of the year. Despite pressure from the left, the Federal Reserve must remain committed to eliminating this stealth tax on American workers and families, and I urge you to continue that resolve. A few weeks ago, Congress took the first step toward getting our fiscal house in order through the Fiscal Responsibility Act. Republicans will continue fighting for sensible spending reductions to combat inflation. This stands in stark contrast to Democrats' spending spree that poured nearly $2 trillion into a supply-constrained economy that was already flush with trillions of savings provided by earlier bipartisan COVID rescue efforts. And after keeping interest rates too low for too long, the Fed was slow to address the problem. In a stunning about-face, the Fed then raised interest rates by 5 percentage points in a little over a year, the fastest spike in modern history. This approach introduced accelerated interest rate risk for which companies, workers, and families across the country were not prepared. The bank runs we saw earlier this year are an example of the consequences. Now, we're told these runs represent a systemic threat to the stability of our financial system. Add in the commercial real estate exposure facing financial institutions, and it becomes very easy to understand the mounting anxiety consumers and job creators share. And I share their anxiety as well. The rapid rise in interest rates, coupled with knock-on effects of the bank failures, have led to signs of a credit crunch across the economy. This would have a damaging impact to consumers and job creators alike. To top it off, Vice Chair for Supervision Michael Barr is undergoing a so-called holistic review of capital requirements. And something interesting that he mentioned in the press even yesterday is a new approach to stress tests that I can't quite understand. If reports are accurate, he's pursuing a massive increase in capital standards for medium and large institutions. This would limit banks' ability to lend money, exacerbating the looming credit crunch and starving families and small businesses of the capital they need. Financial markets will also bear this strain as they will be forced to absorb nearly $1 trillion in new treasuries. This has led many to believe the Fed may be called on to help, perhaps through its repo or other facilities. Clearly, our economy is in a precarious position, from inflation to a potential credit crunch to substantial balance sheet risks for financial institutions. There's a great deal of uncertainty on the horizon. Uncertainty from the Fed supervision and regulation is the last thing the well-capitalized banking system needs now. Following numerous supervisory failures and a new vice chair for supervision at the Federal Reserve injecting politics into policy, it's become clear that Congress may need to again examine separating supervision and regulation out of the Fed and gaining greater oversight and control by Congress in the elected branches. With that, Mr. Chair, thank you for being here today. And the chair now recognizes the ranking member of the full committee, the gentleman from California, for 4 minutes for an opening statement.
Thank you, Chairman McHenry. Chairman Powell, welcome back. First, I'd like to start by acknowledging that the Federal Reserve made the right decision to pause interest rate hikes. As you know, since last November, I've cautioned against any approach to monetary policy that ignores the Fed's maximum employment mandate and results in a recession with millions of people losing their homes and jobs. While we have had strong job growth thus far, experts contend that this trend will not persist with more rate hikes, especially in light of new challenges. For example, the recent bank failures have resulted in the banking industry further restricting credit, making it even more important for the Fed to move with caution. The progress that we have made in reducing inflation is borne out in the latest Consumer Price Index data. In fact, it's been months, 10 months, since the passage of the Inflation Reduction Act, and inflation has successfully been cut in half. Every single Republican member of Congress voted against the bill and chose to cozy up to the wealthy tax cheats instead of working with Democrats to bring down costs for middle-class families. However, the only way we will fully combat inflation is to address the primary driver of inflation, soaring housing costs. Congress must invest more in fair and affordable housing. Under President Biden, unemployment is also at a historic low, and job growth is on the rise. So far, there's been 29 straight months of strong job growth. In fact, a record 13 million jobs have been created since President Biden took office. Democrats are working to build on this progress and grow the middle class so that everyone can share in this economic growth. Republicans, however, just can't seem to get their house in order on the heels of almost blowing up our economy by forcing a national default. They are now picking a fight over a tiny fee of less than 1% of total housing costs, ignoring the costs home buyers are paying with 7% interest rates, appraisal fees, and title insurance. Instead, they're fighting about gas stoves. In fact, just a week ago, Republican disarray got so bad that it halted business on the House floor for the first time in 20 years. Lastly, as we continue to monitor the banking system following the recent bank failures, the Fed must act to correct the supervisory and regulatory failures identified by our committee's oversight. Committee Democrats recently introduced 11 bills, including 3 of my own, to strengthen the safety and soundness of our banking system and hold executives accountable for their misdeeds. The Senate Banking Committee is holding a markup this morning on a bipartisan bill on bank executive accountability. So I urge Chair McHenry to join us in advancing sensible reforms to strengthen our nation's banking system. With that, I yield back.
Generally yields back. I now recognize the Mr. Barr, Chairman of the Subcommittee on Financial Institutions Monetary Policy, for 1 minute.
We expect proposals from the Fed's Vice Chairman for Supervision that could increase capital for financial institutions as much as 20%. Our already well-capitalized banks withstood the COVID shock and severe Fed stress tests as the economy is facing headwinds from the Fed's own rapid rate hikes. Now is not the time to be engineering massive new regulatory changes or hindering regional banks, which have already been under stress. New onerous one-size-fits-all regulation by the Fed needs proper vetting and transparency. I would ask you today to commit to providing us with analysis done so far by the Fed on the Vice Chair's new proposals. I also respectfully ask that the chairman revisit Section 1107A1 of the Dodd-Frank Act to observe that the vice chairman for supervision is authorized only to develop recommendations for the board and oversee supervision and regulation. The law does not give the vice chair special abilities to unilaterally write his own preferred regulations. It does not say that the vice chair should unilaterally write public-facing book reports on bank failures or results of climate scenario experiments. Consensus is paramount.
Gentleman, time has
Yield
expired.
back.
We'll now recognize the Subcommittee Chair on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry, and to Mr. Powell for being here today. In the wake of what seem to be endless novel problems and disruption, I believe the Fed and Congress have done a reasonable job given the cards that we've been dealt. And indeed, it looks like the widely anticipated recession from the endgame of COVID disruptions, if it occurs at all, will continue to be more of a soft landing than a disaster for our economy. While there is certainly more work to be done, but in the immediate term, we can reflect with satisfaction on the historically low unemployment, 11 straight months of slowing inflation since the passage of the Inflation Reduction Act. However, I recognize that the necessary monetary policies put forth to combat inflation have not been without stress, including on the fraction of our banks that chose to ignore the Fed's clear forward guidance on that interest rate hikes were in the pipeline. We on this committee remain committed to alleviating the financial stress for everyday Americans to pay rent and get food on the table. I look forward to discussing how recent policies have performed and what else we should do going forward to ensure a strong economic rebound. Thank you, and I yield back.
Today, we welcome the testimony of the Honorable Jerome H. Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell, we thank you for your time and being here. We'll recognize you for 5 minutes to give an oral presentation of your written testimony. Without objection, your written testimony will be made a part of the record. Chairman Powell, you're recognized.
Thank you, Chairman McHenry, Ranking Member Waters, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report.
Chairman Powell, if you'll pull the mic closer. Thanks.
We at the Fed remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation, economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank, and the resulting bank stress have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman. I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we We were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amount of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is, you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet, and so I can't really get into specific details today.
Well, we like your thinking, Chairman Powell.
I will,
That's what we like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those, and I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system, and we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and DC, with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, et cetera, have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free, 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me and Atlanta Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill? What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the chairman of the committee, and Chairman Powell, great to have you back before the committee. And this morning, you've reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
Well, no, once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation, the membership of it?
Oh,
And who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength. But yes, we're at the top of the league table.
I looked at it this morning, and U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same, no one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic, are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
on the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that one...
In other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing, okay, I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, At your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans, the same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Quarles. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
So
is
you
always an
disagree
appropriate
with
thing.
Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently, we sat quite near each other.
And never discussed the cultural shift?
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall?
Well,
so what
I had no part in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that There are situations in which we need to be more forceful and more proactive, not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired.
The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right, were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. You know, the issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital, the requirements, so what?
They weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember, what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
How much then? Increasing it by how much would have helped?
it's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not. It was not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well-capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee, and he agreed with you. He said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today, even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No. What I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal, you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think?
That an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, agreed among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on lending, raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and expressed my concerns about what the impact of increased capital on the real economy but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome, Mr. Chairman. Thank you very much. This is probably Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would occur.
There is an expectation that the ratio of job openings to unemployed people has been in historic territory, all-time highs for a while now, in the last year or so. And there is an expectation that it will come down. There a while ago, there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6. And that still speaks to a historically tight labor market, where their demand for labor still very substantially exceeds the supply of available workers. So we do expect as things, and that, by the way, that's a way that the labor market can become less tight without having unemployment go up.
I'm sure you're hearing this all over as I am, and that is business people. I have a good friend who has a number of barbecue restaurants in Kansas City, and he is constantly telling me how difficult it is to find workers, to the point where he did something he thought I'd never do, put a sign out in front of his restaurants, job openings. And are there particular industries or sectors of the economy where we would expect this sentiment to be particularly true?
No, and that is right. That is, there's still a significant labor shortage. The surveys at the aggregate level show that it's not as bad as it was 2 years ago. So gradually, businesses are reporting that they're having better able to find workers. Workers are reporting that they're not quitting their jobs as much as they were. That's a really good sign of how tight a labor market is how much people feel free to quit their jobs voluntarily. So those things are all suggesting a gradual cooling and a gradually getting supply and demand back into alignment, but we're not there yet. We still have a significant excess of demand over supply.
Are we also finding that I know in Missouri, that in spite of the fact that there is some, jelly-like movement with the economy, people are still willing to go, in our community, still willing to go out and buy homes. I mean, we're not having difficulty in terms of people going out getting loans, even with the interest rates rising. If all of this continues, if the consumers are constantly paying whatever the interest rates might be, are we going to get stuck just continually going up?
Well, no, I don't think so. So in housing in particular, there is housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that, housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentlewoman from California, Ms. Kim, is recognized.
Thank you for recognizing me, Chairman. And Chairman Powell, thank you for joining us. I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital, and it's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work-from-home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
We're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks, and it's particularly banks that have a high concentration. That's what we look for among the smaller banks, and there are some of those, but there's a playbook for working your way, working your way out of these loans, and it's particularly in the office sector where work from home is still a pretty material factor in some areas, as you know.
Thank you. So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters, so when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are, and then we have a vote. On supervision, it's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them? Okay. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also, on Sunday, March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife, with respect to their business and perhaps other interests, may have had depository interest in SVB. So when the Reserve Federal Reserve Board, the FDIC Board, and Secretary Yellen, in consultation with the President, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances. Did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No, I mean, you know, we were in an emergency situation on Monday morning. There was going to be, and there was a run on banks that looked, you know, that
So
had
looking
high
back,
insured
do you think
depositors.
there was
So
any
we carried out our
Yeah.
duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking
I
back?
have nothing,
from
I have absolutely no knowledge on that.
Okay. Well, thank you. Thanks for being here. I yield back the balance of my time.
Gentlelady yields back. The gentleman from Texas, Mr. Gonzalez, is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning. The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC that has the proposed interest rate increases up until June 14th, recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take, on average, 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the U.S. dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just another, to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things. But
It continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the U.S. dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the full faith and credit of the United States dollar. We should be focusing on mitigating the calls to reduce dependency of the U.S. dollar. Monetary policy changes implemented in the U.S. are likely to cause a ripple effect throughout the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve, and implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial institutions would have a grave impact on local, state, federal, and even global economies?
a strong agreement around the fact that we have quite a narrow role in climate change, and really the important decisions about climate change need to be made by elected people, not by the Fed.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Really appreciate you being here. Look, I got to say, first of all, it was good to hear from the other side of the aisle that the Federal Reserve should not even be engaging in using its tools with respect to climate change or climate mitigation or whatever the case might be. The Fed, you guys have a big enough job as is. Adding anything like that to your job, I think will be wholly detrimental to the American economy. So I, for one, this morning am glad to hear that coming from the other side of the aisle. You've had a couple questions already on capital, bank capital, et cetera. Look, some of the current views are that continuous raises of bank capital will increase costs to our economy anywhere from $50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing Vice Chair Quarles was working on that. It didn't get completed for various reasons, but that, I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed, are you guys kind of concerned about the fact that now it seems like, the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks, and that they're starting to recede from what was, I assume, kind of a handshake agreement in years gone by.
Yeah, I'm not hearing that exactly. We'll be watching that carefully, though.
Okay. Overall, just with respect to capital, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements on a Tier 1 capital for banks. In retrospect, do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
I think it's been a net positive, and as I pointed out earlier, U.S. banks have competed very, very successfully through this period, despite what were pretty significant capital increases that we put in a few years back. So it really has led to a very strong, and also made it well through the pandemic period, I thought, and I think that was a pretty good test. So even though the government did do a lot to support the economy, still, I think that those capital hikes that we made in the last cycle come through looking pretty good.
Do you guys at the Fed, do you have a view of, I say you guys because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years.
Very, very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors as well. And also having interstate banking. Interstate banking only became legal quite recently, and that also has led to consolidation. You can look back, though, look back 30 plus years, and you've seen a very steady decline. So I think there are demographic and other factors driving it, but regulation can fall as a fixed cost, which means that institutions need to be bigger, and I think that's probably part of the story.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall, with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so I saw a heartfelt situation. Last question, running out of time. The SEC has proposed a rule that would, among other things, require banks to segregate client cash held in custody, upending custody bank balance sheets, and by extension, the bank custody model. Are you guys at the Fed concerned about this proposed rule from the SEC?
The gentleman's time has expired. The chairman can
I'll respond to
in
that.
writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell. As you know, the U.S. has foreign adversaries, particularly the CCP, that seem intent on de-dollarization. How seriously should the threat of de-dollarization be taken, in your view?
Well, the status of the United States, of the dollar as the world's reserve currency, is a very important thing to us. I think the reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer, because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also, there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off, the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation, but as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety, and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that, sorry, what was your question before that? It was
to what extent do you factor in safety and soundness when setting interest rates?
Sorry. So we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the mandate of the Fed as a administrator of monetary policy?
I would say no, and I'll tell you why. Interest rate risk is, one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take, the bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds, low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
Gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell, I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what it's done to our Federal Reserve balance sheet. If you take a look at the size of the Federal Reserve's balance sheet since the 2008 financial crisis, we've seen an alarming increase from around $800 million to today's $8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly $700 billion assets between the beginning of your time as Federal Reserve Chair and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic. That caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long-term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are this time the balance sheet roll-off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that. So we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now. But it is important that the balance sheet not just grow with every cycle, and I think I'm very conscious of that.
Chairman Powell, do you have an optimal Fed target for the size of what the balance sheet should look like? A number?
I'll give you the idea, and that is, you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a % of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off, and that's what we're doing to the tune of about $1 trillion a year. And we're in the middle of that process. Now we will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Nevada, Mr. Horsford is recognized.
I thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be threaded is very specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data, and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. Everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them. which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of the labor market continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors, and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So, Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize new home starts to hopefully moderate the imbalance between supply and demand in the housing market?
I think you're talking about longer run, largely longer run factors here, and I think there has been for some time a shortage of housing. It's harder to get lots, it's harder to get workers, and in the pandemic it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed testing, stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics, but until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
So the thing about capital requirements is there would be a 90-day comment period, roughly, something like that, could be in that range. And then there would be a long period of considering those, the comments that are made, and then there would be movement toward coming to an agreement about what to finalize. And after that, so that would take many months, and then you would be into a situation where there would be long phase-ins. So I don't really think capital requirements play into the near-term economic situation the way interest rate hikes do.
Chairman, according to the Bureau of Labor Statistics CPI inflation calculator, it takes $1.16 today to buy the same consumer goods and services as $1 purchased when President Biden took office in January of 21. Do you agree that outsized inflation we have seen since early 2021 has caused and continues to harm workers, retirees, and families trying to make ends meet and pay their bills?
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Nichols, recognized.
All right. Thanks, Chair Powell, for being here with us today. Back in 1995, I worked here in Congress as an intern for Dick Gephardt. I was in his press office, and we had newspapers, where my job would be to clip out the articles and paste them on a sheet. But when I was here in 95, the Grateful Dead were playing. It was one of Jerry Garcia's last concerts, and I was just so disappointed that I missed that concert. But was excited to see that from public reporting that you were at the most recent Dead and Company show. I've been to this version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
Oh, it was terrific. What can I say? So it was great. I've been a Grateful Dead fan for 50 years, so.
Well, I've found one universal truth that I like people who like the Grateful Dead. So, so having said that, you know, I have limited time, but do you want any time to go back to some of the questions that you had? You want to elaborate on anything that you've said here so far today?
You're very kind to offer, but I'm fine with the answers I've given so far, I believe.
Good. Well, you know, back to that show, you know, a lot of people there in Virginia, and like my constituents, you know, they're very concerned about this economy. They're worried about, you know, the cost of groceries, rising inflation, interest rates going up. And when we do these hearings, you know, it's always big news. The things you say, you know, move markets and are very important. But Fed speak is just so hard for my constituents and the American people to understand. What could you tell, you know, the American people who are concerned about the economy in a way that they can really understand where this economy really is heading?
So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates, and while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment, and so that we can have inflation running at 2%, and people can get on with their lives and basically not have to think about inflation. That's what the definition of price stability from one standpoint is, just that people can live their daily lives without thinking about inflation all the time. We want to get back to that place, and we're on a journey to get there. We have quite a ways to go, but we're making progress.
And I've always wondered this, you know, and I think there's a pretty simple answer, but you know, if Congress was in charge of setting interest rates and it became a political thing, do you think that's something that we could handle as a legislative body?
I wouldn't want to comment on that.
That's a safe answer. All right. You know, and I do want to just join on the chorus with a lot of my colleagues on both sides of the aisle here about capital requirements for banks. You know, I brought this issue up with Vice Chair Barr, with Mickey Bowman, you know, and you know, in your written questions for the last time you were here, I didn't get a chance to ask questions because you know, my seniority here on the committee, but you said, you answered in writing, and you said, we've got to be mindful of the trade-offs associated with adjusting capital levels, as it could, quote unquote, cause banks to reduce the availability of credit or to pass higher costs of credit on to consumers, end quote. And you also said that, quote, capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs, end quote. You know, my constituents sent me here to lower costs for working families, so increasing borrowing costs really hits them hard. As the Fed considers new capital requirements, how do you intend to strike that balance between the trade-off that you talked about in your written response?
So that is the balance. You said it very well. So stronger capital requirements mean we have a stronger banking system, means it's more resilient to downturns and crises and things like that, so banks can continue to lend during even stressful times. And so that's very important, and we put a high value on that. And yet, of course, we know that at the margin, the cost of capital goes up for banks, and the cost of credit will go up. So it's a balancing thing, and there isn't any one simple model or answer. So you just have to make a judgment call based on that, and that's what we'll be doing as these proposals are made and then assessed.
Thank you. And I yield back.
Thank you, Mr. Nichols. I look forward to joining you at the next concert with the chairman. We'll see how that works out. Chairman Powell, thank you very much for taking time to be with us here today. Recognize, first of all, that you get, I think politely said, feedback from every sector on how you're doing your job. You are charged with two mandates. Primarily among those are price stability and combating unemployment. As my colleagues have discussed today, the labor market is clearly very tight, and you should be credited with succeeding in maximum employment and being a partner in this. Unfortunately, as we've also heard, and as the country is experiencing, we haven't collectively been as lucky in terms of price stability. Core CPI is still over 4%, and services and housing costs remain very sticky. Given the economic uncertainty on how the Fed will bring inflation to its 2% mandate, can you quickly touch on how the bank capital requirements Vice Chair Barr is proposing? And I'll be specific here. My Main Street businesses, especially farmers, family farms, and Iowans back in my district, really provide a backbone on this, and they depend heavily in this area. Do you think that they will be facing a more difficult and expensive credit environment as a result of this?
I don't think so, and particularly in the near term. So, first of all, many of those people will be dealing with regional and community banks,
right,
rather than with the GSIBs. But even with the GSIBs, though, as I mentioned, the phase-in for higher capital, the process of publishing and then getting comments and evaluating those comments, and then coming to a broad agreement and consensus on what to implement and over what time period, that takes time. And so it will not be important during this period of the next year or two when we're getting inflation back down to target and the economy's kind of normalizing. I don't think the capital the capital changes will have much of an effect in the near term.
So, Mr. Chairman, let me ensure that I'm hearing you correctly. Then, Vice Chair Barr is engaging with small businesses throughout the Midwest right now on potential knock-on effects from this holistic review. Some economic studies have found that these knock-on effects will increase borrowing between $50 and $200 billion. As we look to cut this in half, is this the right thing to be doing?
Sorry, cut in half.
The inflation rate.
Honestly, I don't think the two are really in conflict. We have an obligation to bring inflation back down to 2% over time, and we will do that, and we'll use our tools to do that. But I think the question of bank capital is real. I don't see it as a key factor in how we think about inflation, because again, it'll take quite a while to decide what to do and then to implement. Some of the changes we're talking about will have multiple year phase-in periods, for example.
So, Mr. Chair, let me ask you on that implementation timeline, particularly for new capital standards. You said it would be some years before it would go into effect. According to a report published last year by the Federal Reserve Bank of Cleveland, in the case of implementation Basel III, banks began to increase their capital ratios, and I quote, prior to the publication of specific language applicable to U.S. banks, end quote. And that bank responses, we estimate, to take place well before Basel III rules started to come into force after 2014. Do you agree with the Cleveland Fed, and do you believe that our banks will begin to adjust as soon as the proposal is released?
Yes, I do. It's not an absolute thing where they'll wait until the effective date. Right. They will certainly, and they may even be starting, but I would think the earlier you start, the more gradual the path will be.
Very quickly, I want to turn to a different subject. It's been brought up by a number of my banks back home relating to a central bank digital currency, or any federal issued coin. We have seen how this administration and the last Congress wanted to require anyone who made more than $600 on a third-party settlement organization like an eBay purchase has to report that to the IRS. The existing threshold before the law was modified was $20,000. That is how far this administration wants to peek behind the curtain of what my constituents are spending their money on. And $600 in Iowa doesn't go a long way. It's the equivalent of a PlayStation or paying for your kids' dance classes. I'm a dad of 6. I digress on this, but I do want to know specifically, for my constituents back home, the thoughts of creating a central bank digital currency that tracks individuals. If the Fed were to offer a direct individual account to citizens, wouldn't this be a direct threat to the financial privacy of many Americans?
Potentially, and that's why it's not something we support. We would not support, accounts at the Federal Reserve by individuals. That would not be. If we were to, and we're a long way from this, if we were to, support at some point in the future a CBDC, it would be one that were intermediated through the banking system and not directly at the Fed, for exactly the reason you point out.
I'm very happy to hear that. I think that's a good partnership with the individuals there and a respect for Americans across the board. With that, I yield my time and recognize the gentlewoman from Colorado, Ms. Peterson, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us again today. I come from Colorado. I was in the legislature for 10 years, and when the pandemic happened, I was part of being one of the, unfortunately, elected people during that time, that difficult time. When I think about what our country was going through a few years ago, where our economy was almost in free fall, completely shut down, our local governments were, they were slashing their budgets, they were laying people off, and what that moment meant that we had to do in stepping up at the national level to infuse dollars to save our country's economy. So my frustration here is that we continue to talk about inflation as if it was spending just to spend money, instead of acknowledging the urgent crisis that this country and this world was in, and what we needed to do in the moment to make sure that we were able to recover, keep our small businesses afloat, our local governments, and ultimately recover much more quickly than others. So since we talk about this often, I'd like to know, if you look to other countries around the world who didn't infuse dollars like we did, is there countries that we can look at to compare what the outcomes would be, and what is their recovery like now?
Our recovery is by far the strongest of any country. And I would say inflation that we have is actually, everybody has very high inflation. The EU, the United Kingdom, many countries within Europe as well.
Thank you. That was my next question, is how we compare to other highly developed economies on our recovery. So it sounds like in the emergency that we were in, the hopefully once in a century global pandemic, that the United States ultimately met the moment, and that when the American people look at what has been done, we should feel really good about where we are, but we know we have a long ways to go. And so I also want to acknowledge that something that comes up often is that rising debt leads to increase in higher rates of inflation. Doesn't that also include tax cuts, trillions of dollars of tax cuts that we couldn't afford that went on our rising debt?
In terms of today's inflation? So I think if you look, to your point, you look around the world, there's a common factor that has driven inflation very high in lots of advanced economies, and it's the pandemic, and it's everything about the pandemic: the closing of the economy, the reopening of the economy, the fiscal support, the monetary support, all the things that happened went into high inflation. And inflation is coming down. We'll look back on this, and we'll be able to look back at period of very high inflation. But I think it's not just monetary and fiscal policy; it's also just things to do with the pandemic, various shocks.
Absolutely. It's hard to believe where we were a few years ago and where we are now, although we do have challenges ahead. Another frustration that I have here is our failed policies around immigration reform and providing legal pathways for workers here in this country. When I talk to business leaders across the country, they say that the number one thing that we could do to address inflation is address legal pathways for people who want to work here. And so, while I recognize you say your job is to address inflation, you are still limited only within the tools that you have. So my question to you is, would an increased labor supply help supply chain issues and inflation in this country?
So we're seeing that now very much. A little bit to our surprise, we've seen a bounce back in labor force participation and also a significant return to the prior trend in immigration. And that, we believe, and most analysts would say that that's part of why employers are finding the labor market to be a little bit less tight now. It's still extremely tight, but that more labor supply is helping the labor market get back into balance, including through immigration.
Great, thank you. Another concern that I have is not just now our inability to address legal pathways to work in the United States and the consequences of not doing that to our economy. I really worry about in the long term if we don't address our labor shortage. So I'd like to know if we are unable to provide these pathways looking at the needs of this country, do you see this contributing to the rising costs and inflation here in the United States in the long term?
I'm not sure about the long term, but I would say that, right now still employers are reporting a very significant excess of demand for workers over the supply of workers. And so there's a lot of demand out there for people to work.
Thank you, Mr. Chair. The lady's time has expired. I now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
I thank the chairman for holding this important hearing today. It is critical that this committee continue to explore how the Biden administration's ill-conceived policy and regulatory approaches are harming our nation's economy. And thank you, Chair Powell, for appearing before us today. I'd like to lead off with a question that I posed for Vice Chair Barr when he recently appeared before this committee. As representative for a largely rural district where my constituents, of which 86% are Hispanic, heavily rely on smaller institutions or community banking institutions for their financial needs, I am concerned about Mr. Barr's focus on factors that aren't necessarily material to the recent bank failures. His report on Silicon Valley Bank seemed to go out of its way to advocate for higher capital levels as a cure for the recent bank failures, instead of the failures of regulators and bank mismanagement. In fact, one of your other colleagues, Federal Reserve colleagues, Governor Bowman, echoed these concerns in recent remarks when she said, "The unique nature and business models of the banks that recently failed, in my view, do not justify imposing new overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses." Just a couple moments ago, Rep. Donalds asked you a couple of questions, and your response was that you mentioned how important community banks are and that you are keeping them in mind with all that you do. As I speak with my local community and regional banks, they say that the increase in regulation and in capital requirements will really hurt them. With that being said, what I find as being an outsider in politics, new to the political arena, I find that people here in Washington, people who hold leadership positions, are often out of touch. And so I want to ask you, Chair Powell, do you personally bank with a community bank?
I have over time, not currently, but yeah, the last mortgage that my family and I had was you would like the story, I can tell you someday, but we had a very large bank which sort of failed at the last minute to come through with our mortgage, and we went to the local community bank, and they knew my family, and they knew the house, and they were able to give us a mortgage without difficulty within a few days. So I have very positive experience with community banks.
So with your relationship with community banks in the past, how do you feel that increasing regulatory burdens would have consequences to these community banks?
So I really think that the things we're looking at are not about community banks. They're about the very largest banks, and to some extent, banks in the Silicon Valley Bank range is sort of 100 billion to 250 billion. So that's far larger than I would consider a community bank to be, under 50 and probably under 10 billion in assets. So those are not the focus of the regulatory reforms, I believe, that are going to be proposed to the board for consideration this summer.
And I will also hope that be true, because, as I said, in my district, we have a lot of community and regional banks that would suffer with increased regulation and capital requirements. And so with that, I have very little time, so I will yield back to the chair. Thank you.
The gentlelady yields back. I now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments where the amount the debtor was supposed to pay the creditor was to be determined by the London Interbank Rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit the fan, Congress acted. You published your regulations in February, and the problem is solved. I want to pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone here has talked about the de-dollarization. We need to compete against the euro and against the yuan, but one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization. And when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C. policy that's caused the inflation. We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr. Biden is not president and Mr. Powell is not head of their Federal Reserve, the European Union is, in May, had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%. And since the pandemic began, GDP has grown in the United States 5.3%. In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had 13.5% inflation, 16% interest rates. And that's why I blame the management and also the regulators at Silicon Valley Bank for telling us that, oh, this was an unanticipated circumstance. It's certainly one of the things they could have anticipated. I'll point out that both the Congressional Budget Office and the University of Pennsylvania Wharton School of Business's models both show that the estimated effect of the Inflation Reduction Act on inflation will be statistically indistinguishable from zero. So we'll accomplish a lot for the environment and not increase inflation. Of course, the recent action by Republicans to take away IRS enforcement will lead to higher deficits and higher inflation. The chair of the committee tells us we don't need regulation of our well-capitalized banks. Why are they well-capitalized? Because of our regulation. And I do want to focus on whether our banks really are well-capitalized. Mr. Powell, are our banks well-capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but the marketable securities and loan portfolio is priced at today's interest rates? Under those circumstances, do we have a well-capitalized banking system?
So I think you have to take the capital requirements as they are for purposes of this
Well,
question.
that's the problem. Our capital requirements are hide the facts that are unpleasant.
Right,
If
but-
you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, a rising rate environment has increased the value of the deposit franchise, which more than or at least offsets any portfolio losses.
So we're well capitalized if depositors continue to be lazy and stupid.
The gentleman's time has expired. Chairman Powell can submit any additional response for the record. With that, we'd recognize the gentleman from Tennessee, Mr. Ogles.
Thank you, Mr. Chairman. Mr. Powell, as you know, when the COVID-19 pandemic started, the Federal Reserve began a round of quantitative easing, referred to as QE4. Like many COVID policies, this program dragged on, not ending until March of 2022. To conduct this program, the Federal Reserve expanded its balance sheet with short-term interest-bearing liabilities on one side and long-term interest-bearing assets on the other. And this was at a time of historically low interest rates. When predictably, expansionary fiscal and monetary policy sent inflation to the highest level in 40 years, the Fed was forced to raise interest rates rapidly. Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks managed the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years. And so it does concern me that Treasury is blaming banks for mismanagement when you yourself had to stop remittances and will suffer losses. Now, when the Fed prepared its and I said Treasury Fed, but semi-annual monetary policy reports through the time of QE4, none of those reports mentioned interest rate risk would impact the government's finances. Should that have been disclosed, or did the Fed not understand its own risk in correlation to the interest rate environment?
Well, so what we do, we remit all of our profits, right? And in the era of QE, those profits were enormous. We remitted something like $1.2 trillion in profits to the Treasury Department because, you know, we're funding purchases of long-term assets with issuance, as you pointed out, of overnight, lower rate instruments. So, in a way, that's what was happening during the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about as far as, well, I guess I'll ask this question. When you look at, the roughly $700 billion in blow to the Treasury, how's that going to impact the President and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It doesn't affect spending, right? It doesn't affect, Congress appropriates money, the executive branch spends it. It will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Well, I didn't ask about the budget moreover than our overall economic goals. And I think what I think a lot of us are getting at is when you look at Main Street America, when you look at mortgage rates and how it's impacting, families' abilities to get a mortgage. And so someone who was eligible for $300,000 to buy a home now is no longer eligible for that home. You have people that are now upside down due to this, expansionary, interest rate environment. And I have concerns about, future raises and the impact that's going to have on small businesses, availability of credit, and again, your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families. Now, when you look at Silicon Valley Bank, which is supervised by the Fed, again, I get back to when you look at the interest rate increases, why there was not more warning or hedging from you is the impact it may have on the fiscal system, the financial system, and the banking system, because as we've well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.
Thank you, Mr. Ogles. With that, the chair recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and I thank the ranking member. Welcome, Chairman Powell. Good to see you again. Chairman Powell, I heard some of your comments the last couple of days about the Fed seeking a softening in the labor market. And as a former union president for the iron workers, I always took a dim view of a softening of the labor market because it, reduced bargaining power and that sort of thing. But I do admit that right now, unemployment rates are historically low all across the country. I think Massachusetts, the Fed numbers at 2.8% unemployment. Arkansas, even less. Alabama, even less. So I understand the need for your position. But when you look at the Black and Latino unemployment rates in some of these major cities, they're double that. And I can't help but seeing this as an opportunity to perhaps redouble our efforts to pull workers who aren't traditionally have strong connections to the job market and make things happen. At the federal level, we fund about 25,000 job training programs. And according to the GAO, we don't do a very good job. I think the average program produces about 3 workers per year. But I am aware of the work that the Fed is, the Boston Fed is doing with the Gateway Cities program. Susan Collins is running that in the Boston area. And the Fed actually helps us with data and coordination, and cities like Brockton, Massachusetts, my district, but also Fitchburg and other more rural areas, the Fed comes in and actually provides a great amount of expertise and has done wonderful, wonderful work. And I'm just wondering, are there other tools in our toolbox that the Fed could use to help? You could soften the labor market by adding workers as well. And I'd rather see that on the supply side than simply restrict credit and squeeze companies into a position where they have to lay people off. And I'm just wondering if there are other tools that you think might be available to us to accomplish that.
So I'll say 2 things. First, what the softening that we've seen so far in the labor market has been around job openings declining. It has not been around unemployment increasing. We've seen some wages moderating back toward more sustainable levels. You'll remember well the labor market before the pandemic, where we had 2% inflation and a really tight labor market with no inflation, and a lot of the gains were going to people at the lower end. That's where we all want to get back to, because what we have now is a very tight labor market, but inflation is so high, it's eating up the wage gains that these people make, so we need to get away from that. In terms of other tools, I visited East Hartford, which was another one of those cities, and I agree with you. We're not spending taxpayer money on this. We don't have the authority to do it. We convene people who have private sector funds, and we focus on a city. And I was really impressed. I don't know if you sound like you visited one or more of these cities. It's amazing what you can do.
Yeah.
But as a convener, really, rather than as an agency that has the authority to spend money on people. But so I mean, we do think about these things. We think that the most important thing we need to do for working people is to get inflation back under control, because it is people at the lower end of the income spectrum who suffer most immediately and worst from high inflation.
Yeah, I just think there are deeper structural problems in the limitations within our workforce. I met yesterday with IBEW Local 103 in Boston, and I talked to new electrician apprentices, mostly women of color, who they're working days, their husbands are working nights, and it reflects in that very, very low unemployment number, which is, I mean, you're getting around 2%. it's really people who are in between jobs. Those are the people that are, so there's no real reservoir of unemployed workers there that you can rely on. And I do appreciate the way the Fed came in, and the Boston Fed came in and big-footed the situation in Fitchburg, where they brought a bunch of people together and they accomplished a lot without spending federal taxpayer money. So I'm going to continue to try to find ways that we could use the resources that you have available. Mr. Chairman, I yield back.
Thank you, Mr. Lynch. The chair recognizes the gentleman from Georgia, Mr. Loudermilk.
Well, thank you, Mr. Chair. Mr. Powell, good to see you again. Thank you for being back here. I want to continue a dialogue that you and I had about FedNow. And I also want to continue voicing my concern that this product is a solution to a problem that the private sector is already addressing. The RTP network is already capable of instant settlement with a much greater degree of connectivity than FedNow will have at launch next month or in years to come. And my concern is also that the Fed has an undeniable advantage over the private sector in the payment space, as it can clear transactions through Fed master accounts. Furthermore, the Fed already has options to improve transaction speeds through existing services. For example, the Fed has discussed extending the operation hours for the National Settlement Service since 2015. So first question is, why not respond to industry demand by improving existing services instead of launching a new one that can compete with private industry?
Well, we, as you may remember, we surveyed all of the banks, not just the large banks who stood up RTP, which was a very positive development that we supported. And overwhelmingly, the smaller banks wanted us to set up FedNow. This was a very overwhelming view among smaller banks. They wanted a Fed alternative to RTP. So we set it up, and I would agree with you. That does not a reason not to work on the efficiency of our other payment services, and I hope we're doing that. I mean, I know we're doing that.
So we had also discussed in the past about setting up some guardrails to protect customers from accidental or fraudulent transactions. And we know that's a big issue across the entire financial services sector. And in response to that, you know that the banks already have procedures for customers to report unintentional transactions, and FedNow will come up with a suite of features as well to help institutions investigate and remedy any unintentional or fraudulent transactions. However, with real-time settlements, this becomes a whole lot more difficult than just debiting the account that received funds by mistake. Can you elaborate on how you're going to handle this protection?
Yes, and of course, RTP faces the exact same issues. I mean, it's a problem with real-time payments. You just have to have very high, extra high levels of security around the payments, who the payee is, and that sort of thing. And we do think we can master that and build that in, as any faster payment.
Do you have any ideas of the direction that you're looking to go? How are you going to be able to resolve those? Or is this just something you're beginning to look into?
No, I think we've built very strong safeguards in. I can't give you the technology answer.
Okay.
But we'll be happy to supply that.
Yeah, if you could supply that, I appreciate it. Just a couple other questions. Will the Federal Reserve itself use FedNow for real-time payments between banks and in the system?
I'm sorry, will it?
Are you going to use the FedNow for real-time payments between banks within the system?
Yes, I mean, that's what it's for. It's supposed. It's an interbank payment system that allows banks to offer real-time payments to their customers.
Okay, so with that, I'm going to diverge just a little bit. I've dealt with in the past at state level with government competing with private industry, and we run into this problem where the government has an undeniable advantage. In this case, it had to deal with internet services, where city governments had gotten involved in internet servicing and started competing against private providers. And the issue came that the city governments were undercutting the private providers because of the pole access fee. So we passed legislation in the state of Georgia that required that any municipal government that provides a service that competes with private industry has to assess themselves the same fees. So with that in mind,
will transactions between Federal Reserve banks be subject to the same rules and fees as other banks? Are you going to charge yourself the same fees that the private industry and abide by the same rules as the private industry?
I don't know the answer to that. I will say I wouldn't advocate, in the payment space, there are many, many instances of a government-operated payment system operating side by side with a private sector one. It was not something I would advocate broadly for in the economy. You think about ACH, you think about FedWire, you know, there are private sector and public sector payment utilities operating next to each other in the United States and around the world.
Okay. Thank you. My time's expired. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Well, thank you very much, Madam Chair. I appreciate the opportunity. I want to thank the ranking member, too. Thank you. Mr. Chairman, I've always had great confidence in you. I told you that personally. Now that you're a deadhead, though, I'm not quite sure. Especially after 50 years. But anyway, again, thank you very much for being here. I appreciate the service you've done for our nation. One of my colleagues was talking about the difference in inflation rates in the United States and Europe, on both sides, actually. One of my colleagues on our side talked about that. And I was wondering if you saw the headline today in the New York Times about the UK inflation rate. Yeah. And you saw that they're running, I think, at 8-something%.
Yes, I did see that.
Yeah. And you were asked a question by a gentleman on the other side of the aisle that when the Biden administration took over, what you could buy for $1 now cost $1.16, and that was hurting consumers. And you said, and I want to quote you, I strongly agree. But the question obviously inferred that inflation was the fault of the Biden administration. I mean, that's the whole point of the question.
That wasn't the question I answered, by the way.
That's right. And I was going to say that, and I'll give you an opportunity to answer that, because you later said that the pandemic was the issue all around the world. So is the Biden administration the cause of all this inflation?
So just to be clear, the question I answered was, is inflation hurting people? It was nothing to do with the cause of the inflation. And
but it's inferred, Mr. Chairman, when you say that you know, this has happened during the time of the Biden administration. I think the question clearly infers that.
I think you understand the question I was really answering. So I guess I would say again, you know, people are going to be unpacking the causes of this inflation. Many academic careers will be built on new ways to look at this. Former Chairman Bernanke delivered a paper with a colleague just a couple of weeks ago at Brookings on this. You know, and I just think you see inflation everywhere in the world. There's a common factor here, which has to do with the pandemic. There's also a room for fiscal policy. There's a room for monetary policy in the explanation. And I just think it's very hard to unpack that. And I wouldn't, it's not up to us to make a judgment about, we don't render judgment on fiscal policy. We don't support it. We don't criticize it. We take it as something that arrives at our front door. No matter who is president, no matter what fiscal policy is, it's not something we play a role in commenting on or criticizing or praising.
I wanted to give you an opportunity. I appreciate the answer. I wanted to give you an opportunity just to make sure if there was any confusion about that, the confusion was cleared up, and I think you've cleared it up. Now, I want to answer a question that you didn't answer, that you passed on. The question was if Congress should be in charge of setting the federal rates fund. I can't think of a worse idea. The only worse idea, I think, might be another idea that was set forward earlier, that maybe we should be involved in supervising the banks, Congress. We can't even figure out appliances here, for God's sakes. We closed down the government over appliances. We can't even figure that out. I don't know how in the world we'd be setting rates and how in the world we'd be supervising banks. Again, I think you guys can do a tighter job of supervising banks. I mean, I do think that and you guys have admitted to that with the Silicon Valley Bank, and I hope you do, and I know you're looking at these regulations. It was brought up that since 2008, 2009, their capital requirements have gone up, and the banks generally have done well in the stress test. What was the law that caused the capital requirements to go up?
It was a combination of Dodd-Frank and also the Basel Committee.
Of course.
Agreements.
And those are the two things that have, I've heard from colleagues on the other side, they just keep beating up. Now they don't do it as much, but when I first got here, now that's the CFPB. But that was the choir, again, once again, just saying it's the terrible banking. But the reality is it probably saved banking in the United States, and I appreciate it. Lastly, I would just comment this, and you don't have to comment, I'm just going to make this comment. Obviously, your focus is narrow and should be, but the notion of climate change is important. I do think that it's affecting the economy. I do think that it's affecting our world, and I do think that we've had our head in the sand for way too long on this issue, and we have to do something about it. Obviously, that's not your mandate, but obviously it's important. I hope we do something about it. We don't have the courage to do that in Congress. That's why I think others are doing it for us, but we have to do something. We see the bigger hurricanes. We see these things happening, and it's because of our participation in making it happen. Thank you very much.
Gentleman, time's expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, it's good to see you as always.
You as well.
Many of my colleagues today, of course, have expressed their concerns about the upcoming Basel III revisions, and I hope you'll continue this dialogue with the committee once the joint rule is proposed and open for public comment. I'd like to follow up with a topic we discussed back in March. I'm sure you're keenly aware of how important it is for banks and companies to manage interest rate risk. Participating during the last several years, the Silicon Valley Bank made that very clear. Could you speak generally to how hedging interest rate risk is an important risk management tool for U.S. banks and companies?
Well, I think you see the reality of it here. When rates go up, banks are encouraged by their supervisors and their own internal personnel and risk committees that they need to manage that risk. And most U.S. banks did a good or adequate job of that, I would say. But it's a fundamental risk of banking, one of the most basic risks, along with credit risk.
Exactly. And on that point, I've heard concerns that the Fed's Basel III revisions could increase costs for derivatives end users, whether hedging interest rate risk or commodity price risk. I'm optimistic that these concerns will be addressed. Having said that, these revisions to capital requirements do not exist in a vacuum. The SEC is proposing major changes of their own. Last week, I asked Secretary Yellen if Treasury is coordinating with the Fed and SEC on economic analysis necessary to understand the potential consequences of U.S. banks implementing both significant market structure changes and increased capital requirements associated with market activities. The Secretary responded that the Fed is, in fact, coordinating with Treasury on this analysis. Are you aware of this coordination, and have you personally been a part of these conversations?
I have not been a part of those conversations, but I do understand that that's correct.
Okay. Chairman Powell, I'd like to follow up with you on your conversation with Congressman Gonzalez from earlier today. You have assured this committee that the Fed is not a climate policymaker, and I appreciate your commitment to this. However, I'm concerned that the Fed's regulatory toolkit would be utilized in a way that would, in effect, require the Federal Reserve to make policy decisions on climate change. We've seen other U.S. financial regulators embark on significant climate rulemaking, such as the SEC. Chairman Powell, are there principles you keep in mind when ensuring that the Fed doesn't give in to, shall we say, political pressure around things like climate change?
There are, and for starter, one would be that we don't see it as at all appropriate for us to tell banks what legal businesses they can lend to. That's not our role. We don't allocate credit. So what we do is we supervise banks to make sure that they understand and can manage the risks that they're running. And we're thinking of that as our point of contact with climate change, in the sense that it's another risk that over time banks need to be able to analyze and assess. So, but fundamentally, though, as I mentioned earlier, climate change is going to be a very important issue for a long time, and it needs to be addressed principally by elected people, because it has enormous distributive consequences, and we don't have a mandate to deal directly with climate change as a policymaker. It does arise in connection with bank supervision, but that's not the heart of bank supervision. That's just a small part.
I very much appreciate those comments, Chairman. On another topic, I'd like to discuss the Fed's balance sheet, which currently stands at around $8.5 trillion. As you know, the size of the balance sheet more than doubled as the Fed worked diligently to stabilize markets during the height of the pandemic. Now, as the Fed begins to reduce the balance sheet, could you explain this process and describe the levels of securities that the Fed would look to maintain in the long term?
So the way the process works is securities mature and they roll off our balance sheet. And that's the way it works. And there's a cap for MBS, mortgage-backed securities, and also for treasuries, so it doesn't get too large. And if you hit that cap month upon month, it works out to roughly a little less than $1 trillion a year in shrinkage, which is a whole lot faster than what we did in the last cycle. But then again, the balance sheet is that much bigger. In terms of the level, we're thinking about a level that will allow us to operate our abundant reserves regime with enough of a buffer on top of it so that reserves won't accidentally become scarce. I can follow up more with you on this.
Thank you. My time has expired, Madam Chair.
Gentleman yields back. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here today. I have 2 questions I'm going to try to quickly get through. The first question on the U.S. dollar dominance is kind of a follow-up to Congressman Torres's question. Chair Powell, in the National Security Subcommittee, which I'm the ranking of, we've been discussing the importance of preserving the U.S. dollar's status as a global reserve country. Can you share with us the current status of dollar dominance as it stands today and whether there are risks to the strength of the U.S. dollar in the international financial system? And if so, what are some of the risks?
So the U.S. dollar is still the dominant reserve currency in the world, and that is principally thought to be as a result of our liquid capital markets, the rule of law, strong democratic institutions, price stability over the years, critically open, money can come in and out of the United States without all sorts of legal restrictions and things like that. All of those things are necessary to provide the world's reserve currency. We have them. There's not another economy that does have all of those features. So as long as we are a country of rule of law and relative price stability and strong democratic institutions and open capital accounts, we can continue to be the world's reserve currency. History shows that this is not a permanent status, but it is a lasting one. And I think in the case of the United States, as long as we maintain those characteristics of our government and our country, then we can continue to be the world's reserve currency.
Okay, thank you. Let me go to another question that will not be foreign to you. You know, as the former chair of diversity and inclusion, I asked you and others of your colleagues, and let me just say for the record, Madam Chair, that Chair Powell was always on point, went out of his way, in my opinion, to make sure that there was fairness and equity for all people. In light of that, I'd like to follow up with Congresswoman Waters' comments, and maybe Congresswoman Velasquez, maybe what she was talking about. Several of our colleagues here in the Senate, the person who preceded you, it had been stated by many of us that we thought through banking deregulations, he was enabling risky banking practices and failing to combat lending discrimination, which for some thought it might have perpetuated racial inequities. A few weeks ago, Chairman Powell, on June the 7th, to quote, you said that we understand at the Feds that our actions affect communities, families, and businesses across the country. And everything we do at the Fed is in the service to our public mission. So could you maybe elaborate, or the time ran out with Congresswoman Waters on, is there anything you'd like to share with us that you do at the Feds that would dispel that there are things that you're not looking at that causes one or members of Congress to think that it is perpetuating racial inequities?
Well, as you know, we do consider, we call out disparate economic characteristics of different demographic groups, including by race, and we want those facts to remain present in the room as we're making our decisions. We try to think of maximum employment we do think of it as a broad and inclusive goal, meaning we're not just looking at the aggregate level. I think it's important to keep those facts in your head as you think about monetary policy. I will say, though, that we have one federal funds rate, and we don't really have tools that address distribution and historical inequities and things like that. Really, the Fed is not an agency that has those things. The best thing we can do for everybody, including in particular low and moderate income communities, is to maintain price stability and over a long period of time, and on top of that, a very, very strong labor market. Those strong labor market conditions are the single biggest contribution we can make on this area.
Thank you, and let me end by saying I appreciate your comments that you said you realize that high inflation imposes hardships as it erodes purchasing powers for food and housing from the least of us. Thank you so much for being sensitive to everyone.
Gentlelady's time's expired. Chair now recognizes the gentleman from Michigan, Mr. Huizenga, for 5 minutes.
Thank you, Madam Chair, and Chair Powell, good to see you again. I wanted to follow up on an exchange that we had back in March, this past March, where we were discussing the parameters highlighted in the Federal Reserve Board's legal opinions that outlined how asset managers can operate without being deemed, quote, in control of a regular bank or a bank holding company. Letters from the Fed's legal division also include certain commitments made by these asset managers to ensure the same result. However, it's no secret that this percentage of ownership held by asset managers will constantly fluctuate as shares are purchased and sold on a daily basis. With the ever-changing ownership structure, someone must ensure asset managers are complying with not only these opinion letters, your opinion letters, prepared by your own staff, but also with the statutory and regulatory framework that the letters outline. So, Chair Powell, I'd like to ask you again, is the Fed taking any steps to assess or monitor whether Vanguard, BlackRock, and others are complying with these commitments made in November of 2019 and December of 2020, respectively? Is that ongoing?
Can you give me 1 second?
Okay.
Sorry, that's a very specific question. I didn't know the answer, but so I would say this: we're broadly monitoring the situation. I don't know that we have a particular focus on the asset managers.
Okay. Well, those were opinion letters put out by your folks, outlining very specific things that could or could not happen. And back in March, when I brought this up, and now again today, I'm looking to find out who's actually minding the store on that. And that, so it's a little concerning that we don't have an answer on that. I guess we'll continue this conversation, and maybe you can answer this. What division at the Fed is responsible for reviewing and monitoring an asset manager's compliance with these opinion letters issued by the board's legal division?
So it would be the General Counsel's office. We don't have any reason to think that they're not in compliance, by the way.
But nobody's checking.
Well, we'll check, but
okay.
I think we know what we're going to find.
I'd like to know what you're going to find, not what you think you're going to find on that. So thank you. I'll be following up with a letter to include some more detailed questions on the topic, and I assume you will commit to getting us a timely answer into that.
I think we offered your staff a briefing on this, by the way.
Yes, and there was a briefing, and let me be clear. Appreciate the cooperation that has happened. We've also had some other briefings. There's been a number of briefings that we've requested, and frankly, your your division of government has been more helpful than others, shall we say. So I'm going to quickly pivot to a committee's investigation of the SVB, the Silicon Valley Bank failure. Your staff has been working to get us some answers on our outstanding questions. You did your own report. Now it's our turn. And can you appreciate that the committee, our committee, is conducting its own independent review of what happened in March?
Yeah, very much so.
Okay, thank you. Will you commit to producing the interview notes and allow us access to the staff who participated in the interviews conducted for the Fed's own internal review of the bank supervision report?
I'm not in the middle of that discussion. I don't know where that stands, so I don't want to make commitments that I can't back up. So I'll be happy to understand where that discussion is and try to work with you.
We're going to be following up for sure on that. When Vice Chair Barr concluded that a, quote, culture shift, his words, happened, do you know if the Fed officials spoke with examiners of other banks, or was this conclusion made solely after the review of SVB? In other words, did they find some systemic problem throughout the Fed?
The thing is, I didn't play any role by design in the preparation of the report, and I'm reluctant. I think I know the answer, but I don't want to guess. So we can give you a 100% clear answer on that, but I'd rather not speculate.
All right. Well, along with the FDIC and Department of Treasury, you invoked the systemic risk exemption, the SRE, for both Silicon Valley and Signature Bank, guaranteeing all depositors will be made whole. For example, regulators could have used orderly liquidation authority, the very tool Dodd-Frank was intended to resolve the, quote, too big to fail institutions while protecting taxpayers. Why was the decision to use SRE made, and do you think that is that we've now lowered the bar to use SRE in future bank failures?
I hope we don't have to face that question again.
We all do.
As long as I live.
But has a new bar been set?
I would
No pun
say this,
intended.
though this happened with no warning on in the middle of the night, Thursday night, and less than 12 hours later, we're on the phone with the FDIC, and they're deciding to close the institution and to haircut uninsured depositors. So it was an emergency situation over that weekend. We could see that there was an electronic run building up, and we did what we had to do to address that, and I think successfully.
Gentleman, time has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Madam Chair, and Mr. Powell for appearing. Now, wars have historically been associated with elevated levels of inflation worldwide, although the relationship is complicated and wars can have impacts on both supply and demand. Higher inflation may just be one of the many prices that the humanity pays for the decision to go to war. Now, we don't have boots on the ground, but there's no doubt that in terms of supply disruption and military spending, both Europe and the U.S. are effectively at war in support of the freedom of the people of Ukraine. So my question is the 2% inflation target a realistic and appropriate goal during a time when much of the world is effectively at war? Or should the 2% goal be thought of as a goal for normal times, with policies being put in place that will return to 2% when the war is over, or at least when we've decoupled adequately from the Russian economy?
2% is our goal, and it will remain our goal. It's a medium-term goal, so we're using our tools to get the inflation level back down to 2%. We're not considering changing it because of the war in Ukraine, and I don't know that that's playing a particularly important role in inflation today, although when energy prices and commodity prices went up at the beginning of the war, it certainly was.
Yeah, well, and certainly it's an important factor for Europe still.
Yes.
The disruption particularly. Well, just more generally, you have been trying to deal with this question of how you balance your dual mandate. And so whenever you're trying to optimize simultaneously two different things, the first step is to put them into common units. So just to be specific here, let's say that you're missing your unemployment goal by 1% and you're missing your inflation goal by 1% in the opposite direction. At some point, do those two cancel? Is 1% in one goal equivalent to 1% in the other, or do you need a 2% missing of the unemployment target? how does what are the, I guess this must be implicitly, there must be that coefficient there in the Taylor rule and things like this that try to predict your behavior. But what, internally, how do you view the difference between a 1% unemployment missing of the target versus a 1% of inflation?
The Taylor rule is a pretty good place to start there. Same coefficient on both variables.
Now, is that really true? I don't know. I'd have to go look at it.
In the original Taylor rule.
Okay.
But,
because it's a coincidence if the coefficient is 1. Because you could choose a quarterly inflation target or an annual or a decadal inflation target numerically and get very different numbers. So
It's also, there's a significant amount of research about, the relative social costs of inflation and unemployment, and you wouldn't want to ignore that research either. So I think there'll be a lot of judgment in this. At the current moment, it's not a question because we're obviously the labor market is extraordinarily strong, and we're very far from our inflation target. So we don't have
you're
that
getting
conflict.
complaints from business that the labor market may be too tight. At least it's viewed from the Taylor rule point of view, that there is a penalty that you pay when the unemployment gets too small. There is a target you're trying to hit.
But both
Okay,
sides
and
are calling for tight policy, though.
Yes, that is correct at present, but you can certainly foresee times when they will be in tension, and they historically have been. And so you're saying that pretty much it's a 1% on both, that you take.
I think that's a starting place. I think it doesn't lend itself to that level of precision.
Yeah, well, it's either that or you have to face questions like you've been facing for the last decade, and just how do you balance this? Let's see, in terms of the internet or electronic runs on banks, it seems like that's a new thing that's going to have to inform bank capital and liquidity provider. The first question is, if you get a significant electronic run on a significant sized bank, is there anyone but the Federal Reserve that can provide that emergency assistance? Or do you pretty much have to be the only line of defense against big internet runs?
Well, I think regulation and supervision can play a role in that as well. And
That's in stopping the run from starting, right? But but part of that stopping the run from starting is knowing that if it starts, that there is someone or some entity that can stop it.
we're the lender of last resort, and that is something that only the central bank can be or do. But I would say changes to regulation to assure that that you don't have this mismatch between runnable liabilities and available cash to fund their run-in. That's something we can address and will address through regulation and supervision.
Thank you. Yield back.
Gentleman's time has expired, and the chair now recognizes herself for 5 minutes for questioning. Welcome, Chairman Powell. I want to start asking about the FOMC, the Federal Open Market Committee's latest forecast. It predicted that core inflation will fall below 3% within a year. This forecast has been the exact same for each Fed meeting over the past 2 years and has been wrong each and every time. Why do FOMC participants continue to make the same forecast, sir, and what data are they reviewing to make this forecast?
So in the world of economic forecasting, we don't really have any advantage over private sector forecasters who've been at this. There's a number of private sector forecasters that are well-resourced, and the data are all public. We don't have private data. That's not how this works. And I think essentially all forecasters have made the same mistake, which is at the beginning thinking that the supply chain problems would be resolved quickly and workers would come back to work quickly and things like that. It's just been, inflation has consistently surprised us and essentially all other forecasters by being more persistent than expected. And I think we've come to expect that and expect it to be more persistent.
It just seems that we've moved way past the whole transitory thing, and for 2 full years now, they've been saying it's going to be under 3%, and clearly they've missed that. So it was just a little concerning to me if there was something that we're missing. Let me move on. In your press conference last week, sir, you stated that, and I quote, "The conditions we need to see in place to get inflation down are coming into place." What conditions are you seeing that show that we're moving in the right direction? Because I can tell you, my constituents are still feeling great pain of this inflation that continues to persist.
So there's underlying conditions that I'll mention, but the point is you get them in place, and then the process of inflation moving down will take a significant amount of time. And we've been, consistent in saying that. And the conditions I mentioned would be, first, we need economic growth to be slower than, to be modest, and it has been at modest levels, so that's happening. Secondly, we need the supply chain bottlenecks to go away and get better and improve. And thirdly, we need the sort of mismatch between demand and supply in the labor market to diminish. And that has been happening. So all of those things are happening much later and much more slowly than we would hope. And my committee and I do believe that the process of bringing inflation down is going to be a relatively lengthy one, longer than we expect.
Well, it's clear that the spending on consumer services, for example, a car oil change, a haircut, or a concert ticket, remain almost unresponsive to rate hikes. Do you have a projection for when we might see this spending go down?
So non-housing services, the broad service sector is famously less responsive to and less focused on rate hikes and the cost of capital. So what we think, and that's about half of core inflation, a little bit more than. So we think, and I think broadly, this is what forecasters think, is that it will take some softening in labor market conditions, because in that service sector, it's very labor intensive. By far the largest cost for most service companies is labor. So what you want to see is rebalancing so that demand for labor and supply, a lot of that can happen through fewer job openings and things like that, and we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures the, as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired. And I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here. So in June of 2021 at the Green Swan Conference, you said, climate change poses profound challenges for the global economy and the financial system. In October of 2021, FSOC's report on climate-related financial risk for the first time identified climate change as an emerging threat to U.S. financial stability. And in December of last year, the Fed released climate supervisory principles for large banks that said, quote, the financial impacts that result from the economic impacts of climate change and the transition to a lower carbon economy pose an emerging risk to the safety and soundness of financial institutions and the financial stability of the United States. You've made many comments today that I think are broadly consistent with that in your role, and I appreciate the comments you've made in that capacity. Can I safely conclude that in June of 2023, 6 months after that release, that the Fed's position is still that climate change presents a risk to the global economy and the financial system?
Yes, I mean, I hasten to add, though, that our role in this is an important but quite small one around bank regulation.
Understood, and I'm not asking for the role, I just want to clarify that. The reason I asked that question is because on May 11th, your colleague Christopher Waller at a speech in Spain said, quote, climate change does not pose a serious risk to the safety and soundness of large banks or the financial stability of the United States. and went on to say that the risks posed by climate change are not sufficiently unique or material to merit special treatment relative to others. Should we understand as we sit here that Mr. Waller was speaking in his personal capacity and not as a designee of the Fed, if indeed Fed policy hasn't changed since December of '22?
So I don't comment on what any of the things that my colleagues say.
So I understand, but you understand the concern that if markets and regulators are to understand that the Fed has a consistent policy, and one of the members of the Fed is saying something that appears to be directly opposed to Fed policy from 6 months earlier, that's a concern.
Again, it's governors have always had the ability, and Reserve Bank presidents as well, the ability to have their own views on things, and that's going to happen, and that's probably a good thing that we have a diversity of perspectives. I think there may be less in that difference than you suggest. I mean, what I'm saying is that banks, to the extent we have a role, it is to assure that banks understand and can manage the risks that they do face from climate change.
Okay. Well, I don't want to create internal tension, but I think we're all aware that you, above anyone, is aware that your words are closely scrutinized, and we were concerned with the words of your colleagues there. Madam Chair, I'd like to introduce for the record a working paper from the European Central Bank, The Impact of Global Warming on Inflation. I don't know if you saw this report that just came out recently, but it says, among other things, that climate change poses risk to price stability by having an upward effect on inflation, both food prices and headline inflation. And what I wonder, without opining on their math, if in fact we are looking at a world where climate change, per the European Central Bank, is going to increase inflation, and we were to find ourselves in that world going forward, would the Fed or other central regulators say we have tools to address this, or are we going to say, well, that's non-core inflation, what are we going to do in hindsight? Because it feels to me like we've got a major bank regulator saying climate change is running the risk of inflation, but I don't even know what tool you would use to address that.
You know, I can just say for now, this doesn't enter my thinking in any way that we would, in the near term, change our inflation goal because of climate change or the need to deal with it. There's a lot of thinking and research that over a long period of time, really the process of investing very large amounts of money in a green transition could drive inflation up, but that's not something we're thinking about today. We are not, during our FOMC meetings, we are not thinking about climate change as something that's relevant to the current inflation or to current monetary policy, and that is very much our focus today, is inflation today.
Yeah, and I guess what I'm struggling with is that if we agree that this is a systemic risk, if we agree that this leads to inflation, and we don't really know what role you'd have with tools, there's a concern there. Last thing I just want to end with, in April of '23, the report on SVB, one of the lessons that was noted in the Fed review said that this is an opportunity for regulators and bank managers to be more willing to adopt a precautionary perspective, and that the Fed must strengthen its supervision based on what we've learned. I'm trying to figure out with climate change, if we agree that this is a forward risk, how do we get the Fed the tools to apply a precautionary perspective?
The gentleman's time has expired. The chairman can submit an answer in writing to the record. And I now recognize myself for 5 minutes. Chairman Powell, in March, you confirmed to me that the Federal Reserve is a consensus organization built on garnering broad support before agreeing to any proposal. And given the breadth and scope of the potential changes to the capital framework that is under review right now, that consensus-driven approach seems to be all the more important. I am concerned that the Vice Chairman for Supervision is seemingly been given far too much latitude to act unilaterally, and especially in light of Section 1107A1 of the Dodd-Frank Act, which provides the Vice Chairman for Supervision authority only to develop recommendations for the board and oversee supervision and regulation. Can you speak to the process that's underway? Is the Vice Chairman acting unilaterally, or is that a wrong characterization? And if so, if it's just a recommendation, can you walk through the steps that the board will take from recommendation to a vote?
Sure. So I think what you see is very much the way the statute works, which is the vice chair for supervision has the responsibility, the obligation to develop regulatory proposals for the board that will be considered by the full board. He's, as I mentioned before in another context, he's not the comptroller of the currency. He brings proposals to the board, and the board votes by majority vote to support them or not, and that's how that works. In terms of supervision,
Is he including other members of the board currently as he's?
so I think all of us have been getting briefings on what's developed, but ultimately the job is to present something to the board for consideration by the board.
And how long will that, once he presents his recommendations, how long will there be debate, deliberation, and is that transparent for the public?
There will be a meeting, it could be a virtual meeting this summer to vote on these things. In the meantime, there's a lot of conversation going back and forth now, and we're sort of in that process now, but things are still moving around.
Our concern, Mr. Chairman, is that it seems like right now the vice chairman is writing personalized assessments of bank failures and results of new Fed climate scenario experiments without a whole lot of collaboration with other governors. And so, given that this new scheme could raise capital requirements by as much as 20% in an already well-capitalized banking system, and that the cost of such changes could be $100 billion or more in lost GDP, I am concerned with your testimony that this would only be a virtual vote. Shouldn't this be a more transparent public board meeting and a deliberative process that includes all members of the board?
It's really just a question of calendars and when will people be. It's the summer, but that's something we haven't decided what form the meeting would take. Would it be virtual?
Well, given that it's a pretty big decision, and that the law requires the full board to make this decision and not one board member to act unilaterally, we would hope that the Fed would hold public meetings on the new proposal. Will you and the Federal Reserve Board commit also, when the proposal is voted on, to also include your economic analysis that would justify whatever capital changes are made in a quantitative form?
I don't know that. I'm not sure we'll have exactly what you're looking for, but we'll create a public record that supports the proposal, whatever it turns out to be, and the votes will be what they are, and it'll be subject to public comment and analysis, no doubt.
Well, in order for the notice and comment period to be meaningful, I think market participants will need to understand on a quantitative basis what the justification is for additional capital requirements, if in fact that's what the proposal is, given the fact that we already have a very well-capitalized system. I don't have much time left, but will you also commit to proposing appropriately tailored regulatory requirements based on the complexity and size of the financial institution?
So I will commit to supporting that. I can't commit to what the final product will be or what the vote will be, but as I mentioned at the outset, I do think we benefit hugely from a very diverse banking system, and I wouldn't want to do anything to jeopardize that.
Finally, earlier this week, the Wall Street Journal published an article that stated that, unlike your predecessors, you have not focused on fiscal responsibility. Would you like to correct the record regarding that?
I would, thank you very much. So it was just an op-ed, but it was factually incorrect. I mean, there are countless times, and you've heard me do this, I've said the same thing that my predecessors have said, which is that the United States federal budget is on an unsustainable path, which means that the debt is growing faster than the economy, and that we're going to need to fix this, and sooner is better than later.
Time has expired. Thank you, and the gentleman from New Jersey, Mr. Gottheimer, is now recognized.
Thank you, Mr. Chairman. Thank you for being here today, Chairman Powell. I'm particularly concerned that the current regulatory environment disadvantages small and regional banks. Specifically with First Republic's receivership, I'm concerned that the largest banks were given preference in the bidding process, just enabling the larger banks to grow even bigger. My understanding is that certain regional banks were unable to bid on First Republic because of an extensive and time-consuming vetting process put in place by regulators that put them at a disadvantage in the bidding process. Mr. Chairman, are you aware of a regulator-mandated pre-approval process that banks must complete to bid on firms going into receivership? And is there a notification process for informing banks that they can go through this process? Because I'm concerned that some who wanted to bid on First Republic were unable to.
So this is entirely something within the jurisdiction of the FDIC. We play an important role here, but when it comes down to selling a closed institution, that's just something the FDIC does according to their own procedures. To my knowledge, there were a bunch of regional banks involved in bidding for First Republic.
Do you know if, to your knowledge, if any were said they could not participate, or your understanding was that anybody
Honestly,
could
I don't.
participate?
I'm not aware of any, but I wouldn't be. That really is a question for, that's the heart of what they do. They have the lore, they have the people who have the experience and everything.
Thank you. Small and medium banks hold a large portion, as you know, of our country's commercial real estate loans. The Federal Reserve's May financial stability report stated that the higher interest rates may be increasing the risk that commercial borrowers are not able to refinance their loans, and that a correction in property values could lead to losses by banks that hold commercial real estate debt. I'm particularly concerned that such a correction threatens the stability of lenders and thousands of jobs in my district in northern New Jersey. How's the Fed looking at this and helping small, medium, and regional banks manage their portfolios or think about the risks of commercial real estate loans, and what guidance is being provided to banks given that nearly $1.4 trillion in commercial mortgages are set to mature in the next 2 years?
So following it very, very closely, and I think you've put your finger on it, this is a problem more for smaller banks, and not for all smaller banks, but it's the banks that have high concentrations. There will be losses, particularly in the office and in some of the mall sectors. And what we can do, there's a supervisory playbook, and so the supervisors are in, they're working with the company to help it preserve capital and do the right things to get through what may be a difficult time for some banks that have a high concentration.
Thank you so much. As was discussed today, there's concerns, obviously, that banks may be tightening their lending process and processes and tightening what's available. Are you concerned that higher rates and the recent instability in the banking system will lead to a credit crunch that can make it harder for small businesses to finance their operations and potentially lead to rolling blackout of loan defaults across industries?
So we're watching that very carefully. Bank credit conditions have been tightening for a year, and that's partly as a result of our rate increases. We're very alert to the possibility that the sort of shocks that happened in March might exacerbate that. We don't see a lot of evidence yet on that, but we wouldn't have expected to. So it's something we're going to continue to monitor carefully.
Are you concerned at all about the non-banks and what the crunch that could happen on that side?
Yes, I mean, the banks are obviously highly regulated and have capital and that kind of thing, and some of the non-bank lenders are in a very different place, and so, but we don't regulate and supervise them, and so it's something we're watching.
How do you think we as Congress should be looking at the non-banks? Is there any recommendations?
Where there is same activity, there really ought to be same regulation. You shouldn't be able to conduct the same activity. We regulate these things for a reason, and if we're not regulating them appropriately, then that should be changed. But if you can just go across the street and start a business that does the same thing without the regulation, then that's not going to be effective or fair.
With Basel III conversations up and running and obviously driving towards some conclusions, it appears, or recommendations, is that something that you've been watching? Obviously, you have Fed representation there. What are your largest concerns in terms of requirements and how you're thinking through that right now?
So I think these are going to be very important. A number of very important proposals are coming, and I would just put out a couple principles, and that is, our banks are strong and they're well capitalized. I think that's pretty broadly agreed, and I think we're going to want to understand how even higher capital is justified. There'll need to be a case made for that. Almost as important as that, or maybe more important, is that we need to respect the diversity of institutions that we have in this country. And we benefit from having banks of all different shapes and sizes, and we don't want to push regulation or capital, for that matter, to a place where only the biggest banks have a viable banking model. We're a long way from that. I just think we need to keep that in mind.
Or be disadvantaged compared to our foreign
banks.
Okay, thank you so much. I yield back.
Thank you.
Thanks. Mr. Chairman, we have two more members here, but unfortunately, you're hard stop at 1. Can we go over just by 5 minutes? Is that okay? Okay. No good deed goes unpunished. So we'll go to Mr. Davidson from Ohio for 5 minutes, and Ms. Garcia from Texas for 5 minutes, and then we'll wrap. Thanks.
Thank you, Chairman. Chairman Powell, thank you. Thanks for the extra time so we get all these questions in. And just picking up where my colleague, Mr. Gottheimer, left off, talking about non-banks and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, you know, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that 1.1 trillion was, what was that a year ago? A lot higher.
Yeah, it's had some volatility in large measure due to the lack of legal clarity, and so hopefully this committee will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure, and it'll be clear not just for Congress but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space. But when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where that holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money, and as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically, and I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause? Everything's been settled?
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves. So you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital and the alternative returns in the market, there's a concern, well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So would love to follow up with you on it, maybe align my own views with the thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course we think about monetary policy, and we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that to me continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence, and I think it has some distortions. So as Chairman of Housing and Insurance, I continue to be concerned about that. But the other thing is, really, the big concern is the regulatory side.
Gentleman's time's expired.
Yield.
We'll now recognize Ms. Garcia for the ultimate question of the day.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. It always is a breath of fresh air to have you here to give us the latest report on from the feds. I first want to thank you personally for working on a topic that has always been dear to my heart and dear to the heart of the Congressional Hispanic Caucus. I know several members have already touched a little bit on issues related to diversity and inclusion, and you yourself said something, and I really was struck by the words you used, that when you look at setting the interest rates, you want to reflect that all Americans in the room when you do it. And in my view, the best way to do that is to make sure that the people at the table making those interest rates decisions reflect what America looks like. So I want to thank you again for last month joining you was Adriana Kugler, who was nominated as the first Hispanic to ever serve on the Federal Reserve Board of Governors in its 109-year history. It took a while, but we're there now, and hopefully that will help ensure that when decisions are being made, that all Americans are indeed in the room with you. And so I want to thank you and the President both for making sure that that happens. I know that in my district that is 77% Latino, we're really proud of that fact. But Mr. Chairman, I wanted to see if you could provide me an update on the federal workforce, particularly within the Fed system, because I think that area too, you may recall we've discussed it before in prior times that you've been here, the workforce doesn't quite look like America. So could you give me an update on where we're at with diversity and inclusion issues related to Latinos in the federal workforce for the Fed?
Sure. Well, I guess the place I would start is a good part of the story, which is the directors of the 12 reserve banks around the country. That's been an area where we focused heavily on diversity and inclusion, and I think met with a great deal of success. So relatively high numbers. We can give you the numbers. We'll be happy to. Relatively high numbers of both Hispanics and African Americans and other minorities, and majority of women. So that's been an area where we have a free hand to act, and we can do that. I think in terms of the workforce, we actually had a particular focus at the Federal Reserve Board on Hispanics and working hard, particularly devoting ourselves to a tight focus on generating more Hispanic contact and more Hispanic employees. And I think we had some success with that. We spent a whole year of that, doing that a year or so ago. And so, you know, it's a very important, the most successful organizations in American society, or it's not a coincidence that they seem to me to be the ones that have pretty advanced diversity and inclusion programs, so that they do have, you know, all different parts of America represented around the table.
Great. Another area of concern for me has always been affordable housing. I know that is a challenge for us in Houston, and also the challenge of combating the homelessness crisis across America. I know that the ranking member, Chair Waters, this morning filed some bills related to seeking increased dollars for affordable housing and dollars for tackling the homelessness problem. Do these issues impact the inflation rate and the work that you're doing to lower the cost of housing for all Americans?
I think they may have a marginal effect on inflation. I think more, I would point to things like workforce participation. So people need housing so that they can get to the place where the jobs are, and in many metropolitan areas the rents are very high, so people are having to drive very long routes to get to work. And I mean, labor force participation has an important effect on labor supply, which has an effect indirectly on inflation as well. So,
how long have we had the 2% goal for inflation rate?
Unofficially for a quarter of a century, and officially since 2012. And other central banks.
What factors would have to occur for you to reconsider the 2% since it's been there for so long?
What would have to happen for us to reconsider it? I can't really think of anything. Nothing during my tenure will happen to cause me to want to reconsider it. You know, if you come back in 100 years, it'll probably be different, but it's some unforeseen circumstance, I would say.
Thank you.
Gentlelady's time's expired.
Thank you, Mr. Chairman, I appreciate it.
I'd like
you
to
for
thank the
staying.
Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the witness through the chair, which will be forwarded to the witness for his response. I ask you, Chair Powell, and your team to please respond no later than July 30th, 2023. And with that, this hearing is adjourned.
Thank you.
It's a